Welcome again. This webinar is brought to you by the Business Succession Planning Program, part of the Ohio Employee Ownership Center at Kent State University in Kent, Ohio. We're a nonprofit training and outreach organization located at Kent. We focus on job retention and business growth by helping small business owners around the state of Ohio learn more about the importance of succession planning. Today we have Laura Malone of the American Endowment Foundation. Laura, take it away.
Thank you so much. Thank you everybody for attending, and I wanted to thank Jay and Chris and their team for inviting me to speak here. Part of what this discussion is going to encompass is there's a PricewaterhouseCoopers survey that was done in 2009 that found that a mere 25% of business owners have done any formal planning for selling and transitioning their business. While charitable planning can be a component of the business succession plan, a lot of times that's either not realized by the business professional or not realized in enough time to incorporate that effectively in their exit planning strategy. I do know that Jay and Chris and their team, as well as some of the folks that I pass this presentation along to, are both either business owners or professionals that work with business owners. So part of what we wanted to start off with was just taking a quick survey about how many of you listening to the call right now are business owners. So if you could please respond quickly to the poll that's on this slide that you should see in front of you, that will help give us an idea of the best way to gauge the presentation to the audience. So if you could take a moment right now to respond to that, that would be greatly appreciated. Okay, I do have a couple responses, and I'm going to get ready to move on to the next slide for those of you that are in the process of responding. Okay, I'm going to go ahead and move forward now. Thank you very much for those of you that have responded. Just as a point of reference, American Endowment Foundation is a national public charity. We would be somebody that would partner with the business owner or partner with the business owner's trusted professionals in helping them to create the charitable plan. So as a business owner, if these topics are things that are of interest to you, your first point of contact will actually be with the trusted professionals that you already are working with, your CPAs, your financial advisors, your attorneys, as a way to get the conversation started, and then we can be a resource for the two of you together if you want to continue going forward. I don't want it to be misunderstood that we can be the ones to create the plan. We more assist in helping to open the dialogue. So that, like I said, if there is an interest, that would be something that you would reach out to as a business owner with your trusted professionals, and then we can be a strategic partner in that process. Part of what we're going to cover real quick is just some of the factors about why it's important to have the right team, why the pre-planning is key, what the successful businesses and philanthropy may have in common, understanding the difference between the family capital and the social capital, as well as a quick introduction about donor-advised funds, which can be used as an alternative or a complement to private foundations in creating the legacy of family philanthropy, as well as a couple strategies that can be incorporated and questions to kind of help you as to what philanthropic vehicles may be the best fit for you in your practice or with your business and the succession planning process. For a lot of business owners, one of the things they struggle with is how to find the right team. There was a study that was conducted back in 2005 of 300 former business owners that indicated that after the fact, 75% of the business owners felt the sale did not accomplish their personal and financial objectives. Sometimes that's because they may not have a large enough team, or sometimes that team may not have the depth of knowledge that really needs to be there within the financial planning process. When I spoke with a business owner that we've worked with in the past that used our donor advised fund program as part of his succession strategy, part of what he acknowledged was while he did have the folks in place that he'd worked with for a number of years, those people may not have been the best people for the transition process. And that if he would have taken, if he would have done anything different, he probably would have taken the time to seek out some more professionals that had the depth of expertise in business succession planning to help the process go a little more smoothly. Oftentimes people don't seek out these professionals because they feel like it's going to create an added cost, when in actuality a lot of times the right team should help the process move more smoothly and should minimize the overall cost if done properly. So a lot of times what we like to say is that an ounce of prevention is worth a pound of cure. And it's important for the business owner to maybe keep that in mind as they're beginning to evaluate their process. A lot of times what we also see is people underestimate the time it takes for there to be a business sale. And while the sales to an outsider can go relatively quickly and can be done within a short span of time, if the sale is going to be structured to an insider, predominantly maybe a minority business partner or some trusted key professionals within the organization, or an ESOP, or maybe even selling to the next generation or transition to the next generation, that can be a very lengthy process. And a lot of times the business owners don't fully understand or appreciate how much time that's going to take and don't plan appropriately. Because of that, they end up paying more in taxes, or they may not have the value of the business that they would have had they spent more time on strategically planning the transition, or they may go ahead and find themselves not in the best position to present the business, or may go ahead and lose a little bit of control over the process and may find themselves, let's say, in a fire sale situation or some kind of transition that may not be the maximum goal of what the business owner would have intended. And it's important for business owners to help be aware of that. One of the ways in the focus of charitable planning why the pre-planning is key is because a lot of times for the business owner to get the best benefit of the charitable planning, there needs to be steps that are taken before any pre-existing binding contract is made between the buyer and the seller. If the seller decides after they've already put a deal in place that they want to go ahead and do something charitable, try and create a taxable offset by incorporating charitable planning into their focus, then sometimes they find out that they've made that decision too late. A lot of times also too, there's appraisals that need to be done to establish the value of those assets. If they're working within some of their assets of their business and closely held stock, as they're positioning that prior to the transition of the business, then it's important to have the appropriate appraisals that may take a significant amount of time to get that done and have everything continue to move smoothly. One of the things that we've seen with some of the business owners that have really been able to make their business success, make it something that is worthwhile in how they achieve their end goals and creating the succession plan that they were hoping for, is a lot of times they have effective communication, they have trust in their partners and advisors, they have good planning, and they have a work-life balance. A lot of times that tends to be a matter of maybe helping to keep the a line between the business and, if it's a family business, the role that the family members play in that business. We had a family at one point that they were a very large family. The father created a company. They had 13 kids. Not all of the kids were active in the business, but the father was acutely aware that there was a level of accountability that needed to be with the family members that weren't active in the business. So from the very beginning, they had family meetings that would talk about what was going on with the business, what roles everybody was playing, and to help answer the questions for those that might not be stakeholders, the questions they had in the role that they could do with the business, or why the business may not be operating the way they felt it should be. That dynamic can be tricky sometimes with business owners, but a lot of times we see the businesses that have the most success often have that incorporated within their plans. And also the planning process, like we said, 25% within the PricewaterhouseCoopers study have not created or have created a plan, at least 75% that have not. A lot of times there was a study by MassMutual that was indicating that 50% might have dealt with the plan for estate taxes, but they may not have dealt with what would happen related to buy-sell agreements, or they may not have the appropriate insurances in place for the key employees, which can be part of the business succession process also. Some of these same things that we see that create success also helps the family create success when they're transferring out of the business to create their legacy. A lot of times we find that business owners, once they get into the business growth, once they've achieved the sale of the business, once they're going into that stage of retirement, are looking for what we like to call the transfer from success to significance. That's when they really begin to focus on their matters related to legacy, how they want to be remembered, how they want to go ahead and maybe make their mark on society beyond the business, or how to find ways just to even pass the time if they're not going into maybe a case of serial entrepreneurship and going directly into trying to create some other business. One of the things that we've also seen is kind of within the same model of what creates a successful family business or a successful business in general. We've seen that the philanthropy can also help with creating the business by creating a vehicle where the key staff or the family members involved in the business can create a testing and articulation of values. This may not just be within business succession. This could be within the ongoing business matters as the business is trying to create their mark in their community by finding ways that the staff or the key advisors within the business or the key staff of the business can go ahead and get involved with the community, kind of make their own mark or make their own impression on behalf of the business out in the community. A lot of times it can also create that bridge between what the business is trying to accomplish, the success of the business, and what role they're trying to play in society. If it's a multi-generational business, or if there's a minority partnership, it can create a common ground between those different quote-unquote generations of the business where there can be more unity. And then it can also be a training tool as the business owner is looking at their legacy, looking at the wealth that's going to come out of the business and how those heirs are going to deal with the wealth. It can be a teaching tool for the family of the business or the next generation of the stakeholder of the business to be able to learn more about investment management, the due diligence and analytical evaluation, lessons that they may not be getting within their own careers, or that the business owner may not have had the time to teach them while they were running the business because the business took so much time out of what they were doing. A lot of times we see that the business owners are looking at the fact that they want to sell their business to be able to pass along to their heirs, or they want to get the next generation involved in the business so that the heirs can take over the business and have this be more of a legacy. Ideally, the business owner would like to go ahead and take 100% of the business or 100% of the income they get from the business and pass it directly to the next generation. But often there's not the ability to pass 100% of that asset on to the next generation. There is that aspect of social capital that needs to be taken into consideration. A lot of times that can be a matter of either the business owners having to pay money in taxes, or what most business owners don't realize is that rather than putting that money into taxes, they can put that into a charitable purpose or create their own family's social capital that the family can continue to be involved with and control and have some level of involvement in, rather than just having that money go out into the wild blue yonder where they don't know what's being done with those assets. So it can provide a way that the family can still maintain a certain level of their own wealth without it necessarily be something that gets lost to the government. And that's a lot of times something that is not considered by the business owners because they're trying to get as much as they can within the personal capital, but it can be a way that they can maintain a certain level of capital that has the same personal involvement, if not something that's directly controlled by the family. Kind of a case in point that I want to illustrate is a case study that we got from somebody that we partner with related to a family business. And this may be a little bit larger of a business than some of you may deal with, but I hope it helps to illustrate kind of some of the scenario that is going on within the business succession planning process. The business owner had a manufacturing company for 20 years. He's in his early 50s. He's involved with his family. They have 5 kids. Not all of them are involved in the business, but they are trying to avoid capital gains taxes. They have estate planning issues. The gentleman is trying to phase out of the business within a couple of years. So it's not an immediate need, but it is something that is on the horizon that he's cognizant of. The business owner, and we see that with a lot of family business owners, wants to treat the family equally. Not, like we said, not all of his kids are involved in the business, but he wants to try and create a way that he can do that. And then he does have a $5 million pension fund plan that is part of the business. So the best thing, this is purely to illustrate kind of how the business owner is able to achieve all of their needs without necessarily having to go ahead and lose the money in taxes. And just real quickly here, we're showing kind of the difference between the initial plan that the owner created and the new plan that was created that does have a charitable planning focus tossed into it. So what we're looking at is kind of, if you remember the screen before, we were talking about the difference in social capital and how that social capital can either go to the government or it can go to charity. With the old plan, it was estimated that with the wealth of the family, there was about $10.8 million that was going to have to be paid in taxes. With the new plan, what has happened is they've been able to convert that $10.8 million in taxes into $25.4 million of family social capital. And this can be done either with a private foundation or with a donor advised fund. But the main point we're trying to illustrate here is the fact that rather than that money going out to taxes, it can be in a vehicle where the family can still be engaged and still be active within the process or being able to be active in those assets. The second part of that page, yes, Jay, go right ahead.
I'm sorry to interrupt, but we have a question. Obviously, a relatively large percentage of small businesses involve family members that are in the business. What percentage of businesses that you deal with at AEF actually have family members involved in the business, other than the single owner?
I would say probably on average it's 50-50. And I'm just trying to think of some of the transactions we have going on right now. And of the things that we're working on currently, I would say it's 50-50. And that varies, I think, depending on what's going on with the markets and where the studies are kind of showing that there seems to be a seesaw effect between how many businesses are transferring intergenerationally versus how many businesses may get bought up by outside buyers. And I think a lot of that is probably way beyond my pay grade, related to the kind of capital that may be floating in the markets at various points in times. I think a lot of times you see, kind of looking back historically or anecdotally, that when there's a lot of capital flowing in the marketplace, then a lot of those businesses may end up getting bought by outsiders. But when there's not a lot of capital floating around in the marketplace, then it is more prominent that there may be an ESOP, or there may be a family transition, or even just where there's key staff that may not be family, that may be minority stakeholders, that begin to transition into more of that majority stakeholder role.
Yeah, that makes a lot of sense. Suffice to say, family issues very often enter the picture, and they can be critical issues.
Correct. And a lot of times it becomes multi-level, where it's not just a matter of the family as they're transitioning within the business, but also kind of like in this case study where not all the kids involved in the business are involved. There may be kids outside of the business as well that are part of the family. So how to create that balance between what's fair and equitable among the kids. And that's not necessarily a conversation we'll get into. That's more of a personal decision with the different family members, or that may be led or directed by some of the family's trusted professionals. There was a case study I saw from another professional at one point where they kind of crafted a discussion among the family of how the parents spoke with the kids about what the kids thought would be a fair and equitable distribution among the business, and which of the kids felt they wanted the business, which of the kids they felt wanted cash. It was a very communication-driven exercise, but that helped the parents decide how they were going to create their transition plan. Now, not every family is going to do that, but that is one area where there has been, I think in most cases, there is greater success when there's greater communication.
Exactly right. Yes. And the owner must realize that there's definitely a difference between fair and equal.
Right,
Yeah.
right. And sometimes the best way to determine that is to actually get the kids involved in the conversation, which most owners or most, and not even just owners, but just first generation in general, may not always be open to doing. But a lot of times I think that can alleviate a lot of the stress that happens later, a lot of the arguments that happen later, if the second generation, whether it be with a business or just personally in general, get more involved in what they consider to be fair or equal.
Yes. Good. Thank you.
Sure. Going back into this, though, we're talking about the fact that with the second plan, the family had roughly, when they started before they recreated their plan, roughly about $11.2 million of personal wealth. With the second plan and with the way they reworked different things, and this is a very intricate plan. I don't want to give the impression that this was something that was done overnight. This took a number of years. This took a number of professionals to be able to create this type of plan. This isn't something that the everyday business owner is going to be able to wake up tomorrow and do. But by creating this new plan, they were able to increase the family wealth from about $11.2 million to about $24 million. And then the final aspect of that is just how the social capital and the personal capital work together. And while the personal capital, as we showed in the previous slide, went from $11.2 million to $24 million, you also had the social capital that we showed in the very first slide of these graphs. That was the $25.4 million. That was what would have been paid in taxes. So this can really help the business owner if they take the advanced planning, if they work far enough ahead on the timeline in their business succession planning, and really being able to maximize the overall benefit from both a personal capital and a social capital that the family can utilize. We were mentioning before about donor advised funds, and just as a quick recap of what that is, because a lot of people are still becoming familiar with them. A donor advised fund is a family foundation alternative which can allow the donor to create a charitable investment account within a public charity. We often equate it to the fact of a private foundation is almost like creating your own bank. It can be a very time-consuming and laborious process, whereas the donor advised fund is more like creating an investment account within the bank rather than the actual bank. Because it's held by a public charity, it's governed differently than private foundations. Therefore, it can qualify for the best tax benefits available because it is treated like a public charity versus a private foundation. And then it can also allow the business owner to take a large amount of assets, get the immediate tax deduction, and then trickle out that money on their timetable that they feel to be appropriate, whether it be months, years, or generations, to the charities that they want to support, which is something that makes it act even more like a private foundation would. Just to kind of give a comparison of the donor advised funds and the private foundations, in particular when it comes to the valuation of assets and the taxable benefits of the two. and kind of re-emphasizing the difference of the public charity valuation versus a private foundation valuation. For the business owner, you can go ahead and get, if you're looking at just regular publicly traded securities, there can be the same valuation process. But if you're looking at something that is related to the S Corp holdings of a corporation or the C Corp holdings of a private foundation, of a corporation rather, there's the difference between basis and fair market value, where the private foundation, those assets of the family business would be valued at basis. The donor advised fund would value at market. There can be a more time-consuming process, like we said with the private foundation. The private foundation, once again, we were talking about the process, runs like a business. So the donor would have, or the business owner would have to arrange for the tax returns, the IRS compliance, the accounting, the grants, the fiduciary oversight, all of those different things, whereas the donor advised fund, that's encompassed within their services that they provide. And then privacy, a lot of times with business owners, can be an issue. If they're trying to do something with social capital, they may want to be selective on how they do that. And with a private foundation, all that information becomes public record, whereas with a donor advised fund, there does become an issue, or there can be a greater level of anonymity. Private foundations a lot of times can be best for the families when they want to be able to go ahead and give directly to families or individuals. In that instance, you see a lot of private foundations still being relatively prominent. A lot of times if they want the ability to hire family or staff or reimburse on expenses, then private foundations can also be extremely prominent. And then a lot of times if there's a lot of investment, a lot of business owners tend to be entrepreneurial. So of course they may be looking for new investments. They may be looking for new ways to create leverage. And the ability to create maybe a program-related investment with a for-profit company to facilitate a charitable mission may be a leverage point that the business owner has interest in and is better suited to work with a private foundation. Donor advised funds may be best, like we were saying, if there's an issue of anonymity, or if there's a certain tax sensitivity where with the appreciated property or with the adjusted gross income limits, the donor wants to maximize their deduction, or for that same instance in the difference between fair market value or basis deduction. A lot of times too, the private foundations run into issues, especially when combined with charitable trust, as it relates to self-dealing, or the ability for the family to, because the family may have what the IRS may consider too much control in a private foundation, it may be better to go ahead and use a donor advised fund for that purpose, as well as the fact that the donor advised funds aren't obligated by the same 5% payout provision. One of the things that families assume is related to investments, the charities, all of those things that usually fall in the framework of control with a private foundation. Depending on what donor advised fund provider is being used, the family at times can have just as much flexibility with the investments and the charities they support with a donor advised fund as they do with a private foundation. So a lot of times that isn't a difference between the vehicle, it's more of a difference between who the provider is that is offering that vehicle that the family is using. And that's kind of something that a lot of families aren't always aware of, or a lot of professionals aren't always aware of when they're helping the family make that decision. Part of the gifting benefits that we've seen in a lot of cases is the ability to go ahead and leverage company stock. A lot of times we've seen in those instances where not only are you getting the income tax benefits, but you're also getting the capital gains avoidance. And this can be on an annual level as well as a business succession level. So it's important for the business owner to realize that not only are they, can this be done only at the business succession phase, but this can be done throughout the course of running their business as well to create an added leverage point for them. For this instance, as we have on the slide here, not only with the gift of the $50,000 is he avoid getting the charitable deduction, but he's also saving about $17,500 in income tax because of the 35% of the $5,000 or of the $50,000 rather. Going in and kind of what this looks like within that scenario is just a matter of that the client would donate the 50 shares to the donor advised fund. The donor advised fund would then redeem those shares either back to the client or to a second generation of the business owner, or of the business rather, or some other key employee of the business, or to an outsider depending on what scenario warrants. And then going into a matter of those assets get transitioned back to the business by the donor advised fund reselling those shares. S-Corp business owners have a very unique scenario in the fact that while the business owner can go ahead and get the full market deduction for the gift of those shares, the donor advised fund or the public charity often has to pay the unrelated business tax income when they redeem those shares beyond the basis of those shares. So in this instance, if you're looking at a business owner that may go ahead and gift, let's say $5 million of zero basis shares in their company, the charity would actually only end up getting $3.4 million because the donor advised fund or the public charity would have to pay the income tax or the unrelated business income tax on the shares. What we have is a partnership going on, and this is something that any charity can talk with this organization about. We have an intermediary that can go ahead and take those shares. Because the intermediary is set up as a trust rather than a corporation, because most charities are set up as corporations, they get taxed at a 15% tax rate rather than the 30 to 40% tax rate that the charity in a corporate form would get taxed at. They'll be the ones to redeem those shares. And then when they redeem those shares and get the cash, they then pass those shares on to either the charity or the donor advised fund program. And then they can go ahead and, because they're gifting those shares to another charitable entity, they can then go ahead and get an additional 50% tax discount on that charitable gift. So rather than having that gift only equate to about $3.4 million, it can have the value increase of that gift up to $4.5 million. Now, like I said, the donor or the business owner is still getting the market value for that gift, but what this is doing is allowing them to have more bang for their buck in what the charity or the donor advised fund is able to do in creating that family legacy or fulfilling that charitable purpose that the business owner may be trying to achieve. Going into a charitable remainder trust, and I apologize, I'm missing a slide here. Going into a charitable remainder trust, you have the potential tax benefits of the business owner gifting or removing the asset from the estate without eating up the gift tax exemption. They have the ability to avoid the capital gains tax on the asset. They have the income tax deduction based on the remainder interest. And then there's also the 4-tier payout rule of the income that the business owner is getting back from the trust that can make that a better tax strategy than taking the ordinary income had they invested the asset, which can increase the after-tax income to the beneficiary. Just to kind of show in a graphic illustration here, let's say that we have $1 million of assets that are being gifted into the charitable remainder trust that have $100,000 worth of basis. Let's say the business owner decides to do a 20-year charitable remainder trust, and then they have their charity or the donor advised fund as the remainderment for that, or their private foundation, whatever works best for the family. The business owner can get a 10% annual income interest paid out to them over that 20-year period. So they're still getting income off of that asset. The income tax savings to that donor can be, if you're assuming that they're getting taxed at 35% when you factor in the federal income tax rate plus the state tax rate, and you have the basis of the overall value after the basis of $900,000, there's an income tax savings of $315,000. They're getting a charitable deduction from the assets being given to the trust of a little bit over $125,000. And because of that charitable deduction, they have an additional income tax savings of $44,000, which can give them an overall savings of just under $370,000 off of that $100,000 or that $1 million in assets rather, that they're still able to take income off of. So this can be a very good strategy for the business owner to incorporate into their plan as they're looking at transitioning their business. On the flip side of that, a lot of times if there's an intergenerational transfer where the business owner is looking to do some kind of almost like a generation skip, or if they're they know the value of the business is going to increase over time, and the next generation is going to ultimately have the business, but they want to go ahead and maybe take that asset and allow that asset to grow in a tax advantageous manner. They may choose to take some of those shares of the business or another highly appreciated asset and put it into a charitable lead trust, where the charity may get the distributions up front, and then the family will get the asset back after a number of years. A lot of times this can have the income tax benefits as well as removing the asset from the estate, as well as going ahead and avoiding some of the estate tax or gift tax implications, just like a charitable remainder trust would. In this instance, however, the charity would get the first part of the payout. So in this example, we're assuming maybe $2 million worth of shares with a 15-year payout to the charity through the charitable remainder trust. That would be about 6.3%. Assuming that the business interests that are in the charitable trust grow 4% annually, then the future value of what goes to that second generation, rather than being $2 million, could be $3.6 million. The growth of that asset within the charitable remainder trust is growing tax-free. And when that asset goes back to that next generation, then they're not having to pay the taxes on the growth of that asset the way they would have had to had that 4% growth been happening while the business owner was still holding those interests, or while that second generation was still holding those interests. Some of the family objectives that help families decide whether or not these vehicles make sense, whether or not it makes sense to do a private foundation or a donor-advised fund, can tie into some of the family's objectives and how much time they may have to really take on maybe running a private foundation, maybe looking at what type of charitable giving they want to give. If they're going to support one particular charity just right off the bat, then they can easily go ahead and create some of these strategies to include the specific charities as the beneficiaries of these scenarios. But if they're really trying to create a legacy of family philanthropy, or really looking to leverage that social capital as a tool that the family can use together, then they may want to look at either a private foundation or a donor-advised fund for those purposes. If there's a desire to have some level of anonymity in those contributions, then that could help them weigh their decision-making process. And then whether or not there's the intent of the next generation to collect compensation, hire staff, be reimbursed for expenses. Some of those family objectives are ways that the advisors or the families can get together and discuss what makes the most sense for them. Also, what the family charitable mission is something that may be important. Do they want to have special projects that they're funding? Is their mission going to be consistent enough that they know they'll be able to grant out 5% annually the way a private foundation may dictate? Or if there's grant making that they may want to make directly to families or individuals. We've seen a lot related to the tornadoes over the last couple weeks. And for some organizations, or for some families, they want to be able to go ahead and help those families directly when they fall on these circumstances. rather than go ahead and use the conduit of a 501c3 organization to facilitate the grants made to those families. Also, the tax sensitivity of the family can sometimes make a huge difference in choosing what makes the most sense. A lot of times, we were talking earlier about the charitable remainder trust and the charitable lead trust. A lot of times there's a huge leverage point that could be given by combining both of those vehicles and having income that's going to the family through the charitable remainder trust, and then after the charitable remainder trust times out, having income coming to the family from the charitable lead trust, and those two kind of flip-flopping in how they compensate both the family and the charities that the family wants to support. Also, if there's the need to leverage the highly appreciated assets of the C Corps, the S Corps, or any real estate holdings that may be tied to the businesses, that can make a big difference in how the family is making their decision process. And then also, too, if the family is very charitably inclined or the business owner is very charitably inclined, then the ability to maximize as much as they can to charitable purposes and not lose some of that to the excise taxes that take place within a private foundation can also be something that may be of importance. I did want to go ahead and leave some time for questions, and we are at that point right now. As I mentioned before, we are meant to be a resource to help both the business owner and their financial advisors or their trusted advisors, CPAs and attorneys, create strategies that they can work on together. So I'm hoping that this has been helpful, and if you have any questions, I'm more than happy to answer those for you now.
Great, Laura. If anyone has any questions, just enter them in their chat box. And while you're doing that, I guess I would have a question. Do you see an uptick in the activity that you're getting now, since we're showing some signs of coming out of the recession, hopefully, as compared to 18 months or 2 years ago?
We are. We have been seeing a lot more activity when it comes to the business succession process, whether it be intergenerational or whether it be to outsiders. A lot of the businesses that have been able to successfully weather the economics of the past couple years are reaching a point where the business owner has decided he's had enough and really wants to look at getting out. He wants to try and, or he or she wants to get out before the next recession hits, or they're looking at the fact of, since the business is beginning to increase in value, especially if it's an intergenerational transfer, this may be the best time to create the transition so that the kids in the second generation or the secondary shareholder or the minority partner can really be able to take advantage of that growth, because there is going to be some kind of installment sale or some kind of buyout period that takes place over a number of years. So to be able to sell at a time when that second person can take advantage of the growth helps that business owner to actually make more money as they're transitioning.
Yeah, we're seeing the same thing. That's parallel to the activity we're seeing here at the OEOC in our succession planning program. We're getting an influx of calls over the last 4 or 5 months compared to the activity a year or two ago. 2 reasons, I guess. One is that many of the small businesses are owned by the baby boom generation, and we know there's a large number of those small businesses around the country that are at that point where their owners are at an age where they're thinking about selling and transitioning ownership. And then the recession kind of halted that activity because of the lower valuations. So yeah, I think all the indicators point to much more activity over the next decade in terms of interest in this area.
I would agree with that. In fact, we've seen some reports recently for some of our larger competitors, let's say, where they've advertised the fact that they're stepping up, where they didn't do a lot with this type of stuff before. They're beginning to beef up their operations because they're beginning to see a very big crest coming up with these types of transactions and with the ability to go ahead and work with some of these more highly leveraged assets. You know, that's always been one of our practices. It's always been a way that we've differentiated ourselves. But it is beginning to be something where a lot more organizations are getting more proactive in having conversations with the business owners, because they do know that there is this upcoming wave of baby boomers that are looking to get out. And then as things are beginning to improve, you have a lot more people that are beginning to look for businesses now because they're feeling more secure with the economic climate.
I think there are a lot of investors on the sidelines, a lot of capital just waiting to jump into the activity here.
Right, right. And it's funny, there was a presentation I sat in on the other day where they were talking about the fact of in the early 2000s you had a lot of capital in the market. A lot of people were kind of swooping in and buying businesses. But I think a lot of times right now you're beginning to see a lot more that are beginning to transfer either to minority shareholders or to the next generation, because the capital isn't quite where it used to be. But we are beginning to see a little bit of outsider capital coming in as well.
Right. Well, your presentation's been very interesting. I think this whole area of incorporating the charitable option along with other options as the owner considers ways to transition his or her ownership is something that's often not really understood as it should be. What I'm going to do here as we finish off is I'm going to unmute all the phone lines so that if anybody has a question, they can just speak up.
The conference has been unmuted. The conference has been unmuted.
So we have, we still have a number of people on the line. If anybody would like to ask Laura a question, just go ahead. Well, I guess not. Let's close off the session, and I want to thank Laura for her presentation, and I want to remind everybody that we have offerings in the future by the OEOC in the webinar format as we have done today, and you can check those out on our website at www.oeockent.org. Click on the Exit Planning tab and find future webinars that we'll be offering. So thank you, Laura, and thank you, everybody, for attending.
Thank you so much, and thank you, everybody, for your time. I appreciate it.
Thank you.
Thank you. Please stand by.